and welcome to our latest Insider interview. My name is Dave Baxter and today I'm joined by Craig Baker. Craig is the Global Chief Investment Strategist at Alliance Witan, who run the investment portfolio for the Alliance Witan Investment Trust. Craig, thanks for joining me. How are you doing today?
I'm good, thank you.
So the trust is slightly underweight in terms of its allocation to the US. Where else around the world are you finding interesting buying opportunities?
Yeah, well, as you can expect, when you're asking managers just to give you their 20 best ideas, it's unlikely they're going to be finding them all in one market. And so we're definitely finding ideas in all sorts of places. So, for example, we have a number of stocks in the UK. The UK is a market that's underperformed for a long period of time until kind of the last 12 months or so. There's a number of good quality global businesses that are on much lower valuations than are in the US, for example. And so things like London Stock Exchange Group, Admiral Group, and Unilever, I mentioned Diageo. So there's a number of stocks in the UK market that are looking interesting value at the moment. We've then got a number of sort of mid-cap names in Japan. I mentioned that we've got a Japanese specialist in Dalton who really focus on that area. And we think Japan's a particularly interesting market because there's been changes in that market to try and encourage corporates to spend their cash better and produce better shareholder value than has been the case for recent years. And so there's lots of opportunity for a value manager in that space. We've got some Indian banks that look attractive. We have also got some luxury good companies in Europe. So there's quite a few interesting plays all around the world, as you can expect.
Of course, you end up kind of refreshing your list of stock pickers sporadically. You've had a couple of interesting recent changes. Can you just tell me what's gone on there?
Yes, so in September 2025, we've made two manager changes. So in simple terms, SGA, Sustainable Growth Advisors, which is one of the managers that had been in place from the beginning in 2017, and ARGA, a value manager based in the US, are two managers that have come out of the portfolio. And we've put two new managers in. So that's Artisan, which is based in Milwaukee in the US, who are a value manager. So ARGA were a value manager, Artisan is a value manager, a bit more focused on quality companies within that value bucket. And the second manager that's come in is Brown Advisory. So Brown are split between Baltimore and London, actually, the team that run this global portfolio. They're a quality biased manager, a bit like SGA who have come out, but they are very focused on what is it of the companies they own, what is it that makes the customers keep coming back to that company? So what is it that's getting customer loyalty? And that's something that we think is particularly helpful in an inflationary environment as to how they're going to keep their customers when prices could be rising and the like. So those are good examples, actually, because nothing significant has changed at either of the managers that have come out. We still continue to think they're good managers. We just took an opportunity to upgrade in terms of our conviction in a couple of other managers who we've liked for a number of years, and it's an opportunity to bring them in the portfolio. And they bring something a little bit different. Over time, as managers change their portfolios, sometimes taking a couple of managers out and putting a couple of other managers in changes the balance of the portfolio so that it looks more attractive for the market environment that we're in. So there was an example that we did just in the last month or two.
Obviously, there's been lots going on in markets, and that can prompt stock pickers to kind of move around their positions. So I was wondering, how much change has there been in the actual underlying portfolio this year, and how does that compare with recent years?
Yeah, it's a good question. So we typically are hiring managers that have got quite a long-term time horizon, and so they're not typically running high turnover portfolios. In some cases, that might be 20% turnover or less in some periods. But the interesting thing is when you're running a best ideas 20 stock portfolio, when you get very high volatility in markets, you tend to get more turnover in the portfolio because taking the opportunity to take profits on the stocks that have run up a lot and finding real bargains on ones that have fallen a fair bit. And so you get a bit more turnover because it's that kind of one in, one out policy of, if I want to put a new idea into the portfolio, if I'm keeping to less than 20 stocks, I've got to take something out that I've got slightly less conviction in than the one I'm putting in. So there's definitely been increased turnover in the portfolio this year than in previous years, although that's focused more with a few managers than others. So for example, Jennison in the technology space have made a fair few changes. So as I mentioned earlier, they are a growth manager that focuses on accelerating growth and moving out of ones that have got slightly decelerating growth. And so they actually turned the portfolio over a little bit, moving out of some of the US tech names that have done very well for them into some interesting ideas in China and in Europe. So luxury goods in Europe, for example, and then more recently they've actually been buying back of some of those companies in the US. So that's seen a bit of turnover in their portfolio. And then perhaps the other one I'd pick out is GQG. Now GQG is a manager that will always turn their portfolio over a bit more than others. They will be quite comfortable sometimes being in more growth-oriented names, sometimes in more value-oriented names in other people's parlance. In their view, it's on the quality of cash flows. And so they were, if we go back about 12 months, they were very much overweight the large tech names. And they made a big switch into more defensive names over the course of the last 12 months. Now that's hurt performance over the last 12 months in relative terms, because obviously the market's continued to do very well and be led by a lot of those technology AI themes. But GQG are very much of the view that valuations have become a bit stretched, and so they've really changed their portfolio. So those are a couple of examples, but most of the managers haven't changed the core of their portfolio, but have changed things around the edges.
Alliance Witan does pay a dividend. The shares have a yield of around 2%. How safe is that dividend? And is it the case that you'll need to kind of dip into revenue reserves, or can you fund it through more natural income?
Yeah, so over the long term, we're pretty comfortable that the dividends can be paid out of the natural yield. But there are years where the yield's going to be lower on the portfolio because you're finding areas of the market attractive that just happen to pay less dividends. Technology is a good example where technology companies tend to have lower dividends than you get in a number of other sectors. And so we're quite happy to dip into reserves. That's one of the big advantages of the investment trust space. And in particular, it's one of the big advantages of Alliance Witan. Alliance Witan has reserves well over 3 billion of reserves. It can continue its progressive dividend policy for many, many years to come without that ever being an issue. So we don't put any constraints on the managers that they have to produce a certain level of income. We're comfortable over the long term that will cover what we need, but we will dip into reserves, and we did that in 2024. We will continue to do that if needed.
So you will regularly speak to your kind of underlying stock pickers and get their views on what's going on. What are the big concerns they currently have for markets?
Yeah, well, so the first thing to say is when you challenge them on the companies they own, they're pretty confident in those companies almost regardless of what happens, as long as you're taking a long-term time horizon. Their concerns are more around what could happen to markets in the short term, both in terms of the impact that could have on relative returns, as we've talked about for the first 9 months of 2025, but also it could have an impact on absolute returns in the short term. And so they'll look at geopolitical risk as one of those things. They will look at stretched valuations in some parts of the market, the fact that you've seen some quite extreme moves in stocks, and in particular stocks driven by the AI theme, but elsewhere in the market as well. You're seeing very big increases in share price or decreases in share price based on earnings announcements that are ever so slightly above or below expectations, and you're seeing quite extreme changes in that. So a number of them are concerned about those sorts of things, but in terms of the robustness of the businesses that they're invested in, not at all. And we certainly monitor how those businesses are doing in an underlying fundamentals perspective, their earnings growth and the like, and the portfolio looks very robust on that basis.
And finally, our standard question, do you have skin in the game?
Yeah, absolutely. So a very large proportion of my equity portfolio is invested in Alliance Witan stock, and that's not just me, that's true of the three of us that manage the portfolio on a day-to-day basis.
Craig, many thanks for coming in. That's it from our latest Insider interview. Thanks for watching. Do let us know what you think in the comments. And if you enjoyed this series, do hit the like button and the subscribe button. Hope you enjoyed it, and see you next time.